Today, we will be digging into B2GOLD to see if it is worth staking a claim. Be sure to put on your hard hats, folks. This is going to be a good one. B2GOLD has been around since 2006. And this Vancouver-based gold producer has made quite the international footprint. They have mines in places like Mali, the Philippines, Namibia, and Colombia. We may soon also be adding Finland to that list. In a nutshell, B2GOLD is focused on the exploration and development of gold resources, well, wherever they find them. This is a company that has grown a lot since their inception. They do tend to grow by acquisition, which has helped them become a significant player in the gold mining industry. Just recently, they dropped their 2024 Q1 earnings, and it goes without saying that we will be using that data for this deep dive. Overall, it was not a bad quarter for them. They were forecast to have earnings of 0.069, and they reported 0.081, which is a nice 18.19% positive surprise. In terms of revenue, they were forecast to come in with $590.87 million, and they pulled out $625.09 million for another positive surprise of 5.79%. Despite beating earnings, their overall revenue did fall a little short from a year ago. We will, of course, get into more of the numbers in just a moment. Join today's conversation. Let me know in the comments if you hold any gold companies. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more. And another huge thank you for that click. I had mentioned that their revenue was down from a year ago, and that does make sense when you look at their gold production, which was also down 14.5% year over year. In addition to that, their operating costs were up 25% for that same time period. I do expect to see the shadow of this affecting some of their fundamentals. On a more positive note, they are on track to meet their previously announced outlook for 2024 in terms of gold production. And if gold prices stay high, this could be a good thing for the company. I think it is time to jump into the numbers. And if we are going to do that, it is time to call on the only guy who can find for X every single time, the one and only Mr. Math. Let's begin digging into their surface data and see what we turn up. We have a current value at the time of recording of $3.86. Their market cap, $4.98 billion, and they got a beta of 1.15, so they're just a little more volatile than the market average. Their earnings per share, it is in the negative 0.05. This is never good to see, but with less production and higher costs, it is what I was kind of expecting to see. That price to earnings ratio, we know that's going to be negative as well, negative 101.50. When we are in an unprofitable position, PE ratio becomes kind of useless, so we will instead use price to sales ratio, and that does come in at 1.90. The average amongst their peers comes in at 9.90. Some of those peers include Eldorado Gold at 2.90, London Gold at 4.0, and Osisko Gold royalties at 16.7. They do have the better price to sales ratio amongst that group, and that could also be an indication that they are perhaps on the undervalued side. If we look at their price to book ratio, that does come in at 1.0. The average amongst those same peers, 2.2. The return on equity, negative 0.33%. You guys know I do hate to see that negative, but once they are profitable again, this will flip, of course, back to the positive. The return on assets, also negative at negative 0.70%. This surface data reflected a company that is not profitable in the last quarter. If costs were to come back down and production goes back up, these numbers will naturally look a lot better. Okay, it is time to peel back another layer, and let's take a look at that cash situation. They have a revenue of $1.92 billion, and their earnings in the negative 36.12 million. I do want to clarify that this negative earnings figure is their net income, meaning the cost they incurred was, well, basically higher than the money coming in. Still not a good situation, but on the bright side, their projected earnings growth is 35.84% per year. So that could help turn things around a little bit too. Currently, though, they do have a profit margin of negative 1.88%. Their free cash flow, looking better. I actually thought this was going to be negative too, but it's not. It's $273.66 million, and their operating cash flow, really good looking, $1.22 billion. And this pretty much indicates that they have a pretty good moat for sure. Okay, so now we'll calculate their fair value. So their current value, once again, $3.86. With a discounted cash flow model, we do get a fair value of $4.33. And like the price to sales kind of hinted at, they are undervalued by 11.3%. The 1-year projection for this company is $6.11. So that's a pretty nice looking 59.2% increase. I do think that this is a value you probably should take with a little bit of salt. Analysts have been kind of all over the board on where they've been projecting this company is going to end up. But nonetheless, they've all been to the positive, and that means there could be some potential here for future profits. Let's keep the deep dive going and jump down into their returns data. When it comes to their dividend, they have a yield of 5.623%. It's a quarterly dividend paid out in the amount of 4 cents USD per share. That works out to just over 5 cents Canadian. Their payout ratio is absolutely wonky at 1,600%. Once again, I am going to recommend a little bit of salt with this payout ratio because, quite honestly, some of these negative earnings have inflated it big time. Now, when it comes to dividend increases, they've been doing that pretty good. Their 5-year average dividend increase comes in at a nice looking 63.08%. That's not too shabby. Let's take a look at these returns, and we know they're not going to be great. So for the 3-year, their price fell from $6.19 to $3.86. That's a return on investment of negative 37.64%. That total return after we factor in the dividends comes in at negative 27.45%. On the 1 year, their price fell from $5.32 to $3.86. That is a return on investment of negative 27.44%. With the dividends, we get a total return of negative 23.40%. This year, year to date, it's looking a little better. That return on investment comes in at negative 8.10%. Factor in the dividends, we get a total return of negative 6.81%. So this is concerning, as well. This is a company you would have lost money on over the last 3 years. It is hard to see a positive path forward from here, but it could still be here for sure. In fact, when we get into the final verdict, I will talk about a tiny sliver of hope I am seeing on the horizon. Okay, let's dig down one more time and uncover that debt data. They have a total debt of $17.98 million. This is not bad. I was actually expecting it to be much higher than that. Their total equity, that comes in at $3.93 billion. That gives us a debt-to-equity ratio of 0.50%. What is even more great about this is that their debt-to-equity ratio, it was up at 27.8% just 5 years ago. So we are seeing some very good debt management within this company. They also have their cash and cash equivalents coming in at $567.81 million. You gotta love it when a company has more cash than debt. Let's take a look at the short term. They have assets of $996.65 million and liabilities of $333.64 million. I'm okay with those numbers. On the long term, their assets come in at $4.30 billion, liabilities at $1.03 billion. Once again, I do like those numbers as well. This is a pretty good debt situation. It does bode well for the company as a whole, and that's a good thing for sure. It also makes me think that dividend much more sustainable than that 1,600% payout ratio perhaps makes it appear. Okay, I think I have seen enough to answer the big question. What is my final verdict for BTO? When I look at a company that has not made investors a return for a long time, it is hard to get excited for that company. Could things be on the verge of a turnaround for B2GOLD? The fundamentals certainly are strong enough, and that could be a possibility. A lot of analysts do see the potential for B2GOLD to perform well over the next year, and most have given it a buy or hold rating. I think I agree with that assessment, but with a healthy dose of caution. There have been signs of improvement in the last 3 months, as the share price has actually risen from $3.33 to $3.86. If they can keep moving in that direction, this could be a nice ride up. However, this is one I just feel that you need to be a little extra careful with, and if you are planning to ride it up, then just pay attention to what it is doing, and hopefully the extra caution will just turn out to be me being a little too conservative on this one. If you are interested in B2GOLD, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on some other gold mining companies. Thank you for watching, and I will see you in the next video.